Good morning, everyone. This is Barry Knapp with Ironsides Macroeconomics. This is the free version of our summary of our weekly research note, or strategy note, I should say. This week's note was titled Silly Seasonals. We discussed the role that the pandemic played on distorting data in January. We had a very similar dynamic following the global financial crisis. In that case, it was weak labor market data in the third quarter of the year in 2010 through 2014 or so, as a consequence of the world coming to an end virtually and having a big economic shock at a time of the year when economic activity is generally on a unseasonally adjusted basis quite strong. That distortion to the data led the Fed into QE2 in 2010, Operation Twist and reinvestment of mortgage-backed securities in 2011, and QE3 in 2012. It almost made those programs look far more efficacious or effective than they actually were. We think it increased the Fed's confidence in large-scale asset purchases and led us to the disastrous policy of 21 in our view. But we now have the same dynamic going on with holiday sales. It's distorted the price data, CPI and PPI. It's distorted retail sales. It's distorted the employment data. And it's essentially a function of the market share of e-commerce sales having increased 5% as a consequence of the pandemic, from 15% to 20%, and that just distorting the data. Now, the markets tended to look through this data. 10-year notes are 4.5%, about where they began the year, and the equity market is grinding higher with broader sector participation than we had last year. But there's a lot of narratives that have been altered as a consequence of this. Things like the Fed is done for the year, they're not going to cut it all. We think that's wrong, and I'll explain that a little bit. So the other issues we got to in the opening part of the note, which you can all read because that part of it was outside the paywall, was we do think the eviler of our twin deficits is the budget deficit and is our spending problem. The trade policy thing is China's problem more than it's our problem. This is very different than the whole Smoot-Hawley era when we were the biggest exporter in the world, not the biggest importer. Exchange rates were fixed. There's a whole bunch of reasons why Smoot-Hawley is not a good analog for the current environment. Tariffs are going to go up, and we're going to see if the rest of the world is going to respond to them. We have two things going on that'll be early signs as to whether they are or not. The first one is the German election next weekend, and we do expect the Germans to begin to repudiate Merkelism and their export dependency, energy dependency on Russia, and open immigration policies. But we'll see how that one unfolds. But the other notable thing of the weekend was President Xi of China meeting with Jack Ma and the other technology leaders, potentially loosening some of the reins on the private sector and trying to get macroeconomic dynamism going in China again as well. So those are, for us, very good signs for the world and for those people as well. Again, our bigger problem is our spending problem and our budget deficit. And we think part of the reason why the bond market has been so well behaved is optimism about not just the efforts of Doge, but the efforts of Congress to get spending on track to meet Treasury Secretary Bessent's 3% budget deficit arrow over the course of the Trump presidency. So we really did dig into that stuff in the note. There's lots of details about the Senate or House plan and where spending could be cut. We then walked through inflation again, our perspective on how we got to where we are now, and our perspective that we are going to get housing disinflation through at least the first half of 2025. That's going to bring core inflation down. Even when you look at the inputs of CPI, PPI, and import prices into PCED, the core year-on-year rate is probably going to fall from 2.8 down to around 2.6 or so in January. And that's even before we get to the Feb, March, April numbers, when we really start to get pressure on core. So we do not believe the Fed is done. We then had a discussion of the Atlanta Fed wage tracker, which really validated our view that the average hourly earnings portion of the previous week's employment report really overstated wage the wage growth. And the Atlanta Fed wage tracker is showing us two things. One is there's a lot of pressure on the lowest income quartiles, hourly paid workers, and so demand for labor is weak and churn has absolutely collapsed. We've never had the spread between switchers, job switchers and stayers negative at the same time that we've had what we call the wage differential, which is the spread between the lowest income quartile and the highest income quartile negative at the same time. This labor market is dead in the water right now. The Fed needs to start cutting the policy rate again to start helping that small business credit channel and getting demand going again. So that was the macroeconomic stuff in the report. We are comfortably long the equity market here, and we're taking a little bit of a flyer on Germany ahead of the German elections. So to get really all the details, our sector allocation and asset allocation, please consider becoming a full subscriber. If you want a trial to have a look at it, we're open to that as well. Barry Neff from Ironsides. Have a good week, everyone. Thank you.